that I actually really liked was on our term product, and it was a note that stuck out with me from Vince on the call to kick off your Q2 meeting at Life Plan. And that was how Vince, if you remember, he was saying that he receives a lot of flyers and door hangers and even calls from real estate agents in his neighborhood. Obviously, a very in-demand market for real estate right now. That's been really all over the news. So how can we leverage that from an insurance standpoint? Well, as Vince said, clearly that advertising worked out well. He took notice. I think he even said he chatted with one of them or is seeing a lot of houses still continue to go up in his neighborhood because the market is so hot right now. Whenever there's a house being sold, there's going to be a mortgage more often than not anyway, especially with today's rates. So what can we do from a mortgage protection standpoint? There's still a big stigma that people believe they need to take what is offered from the bank. But unless you consider the bank one of your loved ones, why would you need to protect the bank for your house? You know, that kind of goes along the lines of, if you're doing a bank mortgage, what you're really doing here is setting up that you're covering them. If something were to happen to you and you die, or your spouse, and you're unable to make payments, then you're really setting them up so that they recoup what they've lent you from the mortgage standpoint. With insurance, we really want to change that. And you can use life insurance to set up for the mortgage. As you see on this slide, you get to choose the beneficiary. You know, it doesn't go directly to the bank. It goes to your spouse or whoever you've determined is going to be the receiver of those funds. They can then use that money to pay off the mortgage. It's not automatic. It gives you a lot more control. And I think when you loop that into a really hot real estate market right now, I believe that life insurance policies should be flying off the shelves. What I like with Manulife as well, we do have a marketing feature. If you really wanted to kind of piggyback on some of those realtors, you could call one if you're receiving similar marketing material as Vince was. We have these customizable door hangers that you could put around different neighborhoods. And on the back flip side of this, it has what was listed previously here, just kind of some yes and no options comparing life insurance to the bank mortgage insurance, as well as your contact information, your picture, however you want to customize that. So we can order those on the Manulife Advisor portal with the form number MK2669. I just think this is a great way to, again, tie into something that is really in the news and capitalize on a lot of market opportunity that's out there, because a lot of banks are still reeling in a lot of mortgage insurance, where I think from a life insurance perspective, it just makes a lot more sense. The next component under our term umbrella was going to be something that's unique to Manulife called combined coverage. And it's really our answer to joint first to die coverage with other competitors. With term insurance, and specifically joint first to die, again, these are a lot of mortgage opportunities. You're clearly setting an amount for that needs analysis that you've run for a defined need. And it's typically to help protect the survivor in the event of an unexpected death. So the way the joint first to die works, you have a shared risk pool between two clients. If one of them were to pass away, unfortunately, the survivor then receives the death benefit. With combined coverage, what we do is actually, again, insure two people under the same policy, but we provide them each a coverage. Now, it has to be in matching term option and term amount. Let's say term 10, 500,000. What would occur then, and one of the benefits here is, let's say that unexpected death occurs to both individuals. There are two death benefits. It's important to remember that these are actually two distinct coverages under one policy number instead of one shared coverage. What we do with this is we actually offer a 3% discount. It works out to about 10% if you're paying annually, so that we slot in, within a good competitive rate compared to a joint first die policy, but then with so much more benefit in between. Another component that I like about this is the conversion privileges within Manulife. When you have two coverages, you have two conversion opportunities. You could then convert these into their own distinct permanent plans down the road as you age with the client in their life cycle. You could split different policies. So if there's no longer a need for insurance, you can split them off into their distinct own policies. That also happens with marital breakdown. It's very easy from an administrative standpoint to make this all work in your favor. Again, kind of providing two for the price of one. Really big differentiator for us here in the market, especially when you are trying to piggyback on some of those mortgage insurance opportunities and providing a surviving benefit to an individual right up front. I will ask too, actually, I don't necessarily need to, I should have said this at the beginning, but I don't necessarily need to have the whole flow. If anyone has a question, feel free to just raise your hand or jump in and stop me. I'm happy to answer as we go, or if you want to save to the end, just note it down and I'll answer as well there. Another component of our term coverage is an exciting program known as Manulife Vitality. And if you've been around Manulife for a few years here, you've definitely heard about this program. So I don't want to get into too much of the weeds or too much of the nuts and bolts on how it works. But really what it is summarized in this graph here, or sorry, this comparison table here. It's still, at the end of the day, your regular term insurance. It provides a death benefit in the event of an unexpected or expected death around life expectancy. What it also provides is a health and wellness program that rewards individuals for healthy living. These are some of our rewards partners. There's hotels.com, Apple Watch, Amazon, Good Life Fitness. I think what really stands out about this slide to me is just the additional value that you can get and add to your, not only your clients, but to your business with Manulife Vitality. How it works is when you sign up for your term policy, there's an invite to join an app or a website called Manulife Vitality. Vitality started out actually as a health and wellness program in South Africa and has grown internationally as its own distinct company. Manulife just partners with Vitality to have exclusive Canadian rights. What then, when you sign up for this app does, is it will encourage you for healthy living and give you points for doing so. Through your policy year, you accumulate different Vitality points. That puts you into a different tier. A status here is bronze, silver, gold, and platinum. And that'll help determine future premiums as well as different rewards opportunities. Try to think of this kind of like that disruptor that happened with auto insurance. When you're putting in that tracker that shows, you're following speed bylaws in different regions, if you've been, quote unquote, a safe driver, it could reduce your insurance premium. This works similar. So if you're showing that you are engaging in healthy living activities, why are we not going to reward that? Two 35-year-old individuals might not exactly be the same on paper. They both don't smoke, and they both have no pre-existing history. Who's to say that one is going to be the exact same as the other? They're not. I could be 35 years old and sleeping on my couch every night and, a little bit of a drinking problem, anything like that. Or then, on the converse side, you have someone who is vegan, who does all of these things that are exercise that are really important to their health and wellness. And why should they be paying the same amount of premium, right? Now, it's not necessarily just for those that are super health conscious or super health obsessed. It actually rewards people for doing things that they might already be doing. Just for a non-smoker declaration, you would receive $1,000 or 1,000 points, $1,000, but 1,000 points towards your points goal that'll have you some savings down the line. There's different things like a flu shot, going to the dentist, just getting a routine physical. These allow you to accumulate points throughout the year. Each year you get a 10% rollover, and then your policy anniversary, it starts, so you reaccumulate new points that you can use for your reward opportunities. Those are things like a 55% discount at Good Life Gym. Hotels.com, if you're in the gold tier status for hotels.com, you get a 25% off of a 2-night stay. Some of these policies, even when you're dealing with, for instance, hotels.com, your savings could eclipse your entire premium for the year. We actually had a coworker who put this to the test where they went to Las Vegas for a weekend with a group of girlfriends, and they got 2 nights in a suite. The savings that they had on the suite was about $750 total. That ended up being more than her yearly insurance premium. So kind of a win story on that. That's without any of the other opportunities for awards. Where I really find this then helps you as the advisor is because we've seen a lot of trends here in the insurance market. And as we know, insurance market is slow. we are obviously way behind on tech compared to other industries. You know, you think about the Amazon, the Netflix, a lot of the digital online purchasing. This rise of non-traditional channels, you know, what if Amazon were to come out with their own insurance product? Consumers are showing that they're more open to these routes than just going in the traditional insurance company market. There's also an increased trust of online information. People are doing reviews, reading reviews, comparing, and shopping before they make those purchases. We're seeing a lot more of informed shoppers, which is different from in the past where they might just be solely coming to a financial advisor for this information. There's also a shift to digital interactions. This really came on a lot stronger through COVID because obviously we couldn't meet face-to-face, unfortunately. So people are seeing a way to continue to do business through digital interactions and are fine and comfortable, in fact, operating digitally entirely with different companies. Lastly, I think there's a real need for personalized offerings from advisors. I think that when you're showing that a plan is tailored and holistic to an individual and will be unique to them as they start their own path on a product, it's something tangible that people are looking for now, where in the past it would just be kind of like owning a product. Again, this is kind of showing how the past role of an advisor is kind of changing as well for the future. I think this is great because it's more focused on building relationships and personalizing solutions for each individual. There's not as much cookie cutter out there. And again, if you have 2 individuals that are wildly different in lifestyle, how is it that we can shoehorn them into the same product? But I think with the advisor market, another problem is that insurance is seen as a grudge purchase. You know, this has typically been a conversation about death. It's what happens if you die? I have to have this, and you know, I don't even really benefit from this. It protects my family, right? It's seen as something substitutable. You just kind of shop around, see what the biggest rate or the best rate is from our competitors. It almost becomes like a commodity in terms of whatever's lowest stakes ends up winning. What Vitality does is embeds value within the price so that you are building a relationship and seeing engagement through the product life cycle. I find there's 3 then ways that it creates value for your practice. Again, this is an easier conversation to have around life insurance with younger individuals. It's focused on their health and what can we do about their longevity and protect in case something goes wrong. It's not necessarily focusing on a death benefit. You can point to different things year to year that then client can engage with that focuses on improving their health. I find that this, again, sets you apart in what has become a commodity market. I like to call this the barbecue effect. If your client, let's say they partnered with our Apple Watch offer and we're able to get, actually mine's charging because I forgot to put it there last night, but we're able to get an Apple Watch. Whoop, dropped my mouse, 1 second. We're back. They drop the Apple Watch component and someone says, hey, you know, I've been thinking about wearing an Apple Watch. How did you get it? Where do you like it? Or how do you like it? Where did you get it? What they can say is my advisor actually got this through an insurance policy. If this person has insurance, they're thinking, what has my advisor done for me lately? How cool is that? That they get that latest piece of technology that everyone is seeking out to purchase, and they can get this through their insurance plan. That's going to enhance kind of referral network and build just deeper relationships as you're adding more value than just an insurance plan. What I like to then capitalize on that is that it's not just something that they're buying. your clients are experiencing this. They're engaging within an app. When they think of that app, they're thinking of you. When you do a review each year, you can ask how they've set on their health and wellness goals and check in with them. It shows them that you care and that you're not just selling a product that's T10 or T20 and talking to them right before it ends. I like this slide. I'm just going to kind of move past it, but what I really think this does is encapsulates those last three in the additional value that you're providing. You heighten customer expectations because there's now a more valuable product. You show that you're concerned about their health and their wellness, not necessarily looking forward to when they die, they pay actually that death benefit. And it'll lead to hopefully higher sales metrics. You're getting higher referrals because of the enhanced value that you're adding to this product. Generates then higher sales, and you have more engagement along the way as the client engages with the application to then think of you and think of the different opportunities for maybe it's for conversion or for switches, and to do more needs analysis on other opportunities within their lifestyle.